There you go.
On this show, on several occasions, we talk about the propensity of the market to close the week on the highs or the lows. Unfortunately, we already made a new low for the week at 5409. The S&Ps, I'm sure many of your stocks did. Earnings reports are primarily responsible for that. We'll go over those. Jobs number at 8:30. I mean, is there going to be enough data to go a half a point? People are talking about a half a point in September. I don't know. Ryan Dietrich, 8:35. If he caught his connecting flight, will be here and give us his take on the markets. It's going to be a wild day. It's pre-market prep.
Welcome to Benzinga's pre-market prep.
This is a volatile puppy here.
It's all about execution styles and strategies.
Good morning, traders and investors. Starting out deeply in the red, 61 handles at 44.1950. We just took a hit pretty much off that opening bell and move it into the multiple lows at the 5400 area. We can talk about that in just a few minutes. The buck is in the red by 38 cents here at 103.82. TLT, flight to safety perhaps, or maybe that half rate cut that it might be on the table now. Up 84 cents, 96.15. Crude showing a little weak this year, down 63 cents, 75.68. Flight to safety gold up 20, 360 at 25.0440. Silver back over 29. That's up a double nickel. Bitcoin is having a decent day, up 2%, $1,315, 65,115. And going with me today, just me and Aaron, besides our guest. Let's bring him in. AB, how you doing?
I'm good, Joel. I could be doing a little bit better if the market was holding up better, but we've got a lot of volatility. We, of course, have the jobs numbers, employment report coming out at 8:30 as well. And now, a couple days after the Fed's decision, it's looking like a lot of people wish now in retrospect that they would have made that quarter basis cut because, boy, it looks like the market sure does need it right now.
Yeah, and we had this conversation when we first got on, and and I'll throw it to the chat here. Things happen in our day. We can't be on all day covering every single thing that goes on the markets. And I was in and off the office yesterday, and things were great. I mean, things were like peachy keen, right? We kissed 5,600 early in the morning, right? You see that just before the noon, and then the noon balloon hit, and they came in with their solid shoes. We talked about it. We'd like to find catalyst, and I just have to say international turmoil. I mean, if maybe there was another headline that I missed, but certainly a lot of angst over there in the geopolitical situation. Not sure what you guys are seeing there. I'm sure everyone has their own source. Or is this, Aaron, I'm going to ask you, is just this is going to be the way? Is this the market? Is this what we're living with?
Yeah, I mean, I think it's the market this week has gone like up 3% one day, down 3%, up 3% the next day. I mean, I'm talking about the Qs here, the SPY, a little bit less, like 2%, but it's just, I think the volatility, I think people maybe got a little bit tentative, scared ahead of those big reports last night, which we'll get into, as well as the job reports today. And from all of the lack of volatility that we had for the months leading up to the last few weeks, that's been replaced with, volatility and more. And it's just been kind of crazy roller coaster ride here if you're in the markets. And it's like your guess is as good as mine on any given day if it's going to be one of those days where you bounce back and go up 3% or get crushed. Obviously, so far, the big tech earnings haven't done that much to help the market. I mean, we thought once we saw Meta that it was going to be like, oh, okay, well, Meta just saved the market, and then it didn't really end up happening.
Yeah, and that did get AMD'd, right? Remember how I talked about yesterday, AMD being way up, giving it back. Of course, Meta had market dynamics working against it big time yesterday. But, and I see questions here. Someone, oh, we're going to rally 3%. Oh, this is the bottom, yada, yada, yada. I don't know what's going to happen today. I don't know if we're going to hold 5,400. I don't know if we're going to have some miraculous rally and get over 5,500. But what I do know is we need to calm down. The market needs to calm down. These 70, 80, 90, 100-point intraday ranges, 150 yesterday, that doesn't bode well for this market to just turn around on a dime. So, all right, let's get to those earnings reports, Aaron. Where do you want to start?
Let's start with Amazon, which of course reported yesterday after the close. Amazon this morning trading down 8%. So you had Amazon reported EPS of $1.26, which beat the $1.03 estimate. Sales came in at 147.97 billion, missed the $148.5 billion estimate. But really, it was the guidance, and they issued some soft guidance here. It talked about, and actually, in the call, they talked about consumers being distracted by,
Did you see that too?
Yeah, they talked about the consumer being distracted after the Trump attempted assassination, as well as the Paris Olympics going on. And I mean, like, come on, it just seems like such a, like every single company in the world is dealing with those things, and you're going to blame that for weak earnings. So it seemed like, all in all, the numbers just weren't great for Amazon. Of course, the forward-looking guidance is what the investors are going to look at the most. And, Amazon's was not great. So you saw that stock immediately get hit last night, continuing to move lower this morning. So Amazon shares closed at $184 yesterday, now trading below 170 this morning.
Yeah, I love that. And usually us media people make up stupid excuses like that. So they must have really had to put their thinking caps on to come up with that one. Oh, yeah, the Olympics. I'm not gonna, like, you can watch the Olympics and you can go on your computer and you can buy stuff on Amazon. In fact, I did. I bought a new shaving kit. So I don't know exactly what they're talking about here. But what we care, whatever, the action down $15, 8%. That's a whooping. We haven't seen a day like this in a while. So what only thing we can do is we go, well, the pre-market low is 167.14. That's about $2 away. It could be more or less depending on what happens at 8:30. But I think what you have to do right now and focus, whether you're a long-term, short-term, medium-term investor, is just look at all these lows after that gap area. And, I always fear gaps because I always think they're going to get filled. A lot of times they don't, but here you are. This after February, you had dips at 65.75, boom, 65.24, boom. You came down there again on this day at 66.32. Haven't hit it yet in the pre-market. What I would say is if I had some wild short or some wild options that are trying to capitalize on that area, I'd keep a real close eye on it. If I was looking to add Amazon to my long-term portfolio, I don't know. I'd wait another day or two and let the dust settle, see if you're going to get to that 160. And if I'm long Amazon, holy mackerel, I'm scratching my head. I mean, of course, whatever your cost base is, if you took it home for a day trade, you're getting absolutely annihilated. I just will look at the bottom of yesterday's range, and that's a long ways away, 181.87. Right now, that's the only resistance I can give you. And who knows, if we have a great rally, I mean, it could get up to that area. But longer term, I think you got to see if we can hold 160, bounce up, see if we can get back. I'd even be like near 180. I think anything near 180, people are like, oh, just give me 180. I don't care about the mark. I don't care about yesterday's low. That's a little bit longer term.
All right, well, let's go from Amazon to Apple, which also reported yesterday after the close. Numbers a little bit better for Apple here, but just a very muted reaction because of the backdrop that Apple reported. And so Apple reported an EPS of $1.40, beat the $1.35 estimate. Sales came in at $85.8 billion, beat the $84.53 billion estimate. A little bit weaker iPhone sales, some concerns in China, but overall the numbers were good. And the guidance from Apple was not as poor as Amazon's. You did see Apple stock bounce a little bit after the report. Apple closed down about $3.70 yesterday, bounced back, but trading pretty flat this morning here. So all in all, I mean, Apple's holding up compared to like all these other companies that we'll talk about that reported. But either way, I mean, it wasn't, this type of blowout report that we've come used to seeing from Apple. And again, like if you're, bought Apple into the report thinking they were going to crush it, you might be a little bit disappointed here.
Yeah, you had to pop up to 224, which it was shy of yesterday's high, so you never got to look at that in the after hours trading. This pre-market low, they got pretty excited here. They took this thing down. Excuse me, the after hours low is 212.35, but we're $6 above that. So that's to me, you might have to pick an intermediate level to get long above. I mean, right now, for the short term, I'm just would focus on 216. If the bulls can make a stand, I know that's way above the pre-market low, but 3 lows at that area, 216. So you have to look at that. Now it's green on the session. It holds that. There's 3 lows. That's buffeted by another low at 214. But you get 3 lows in the same area. Those were, 3, 4, and 5 sessions to go. I give that minor support. And then since we're quite a ways from yesterday's high, if you get a good number, you good a rally, maybe look for that 2-day mark of 222.08 because Apple did not have a bad day on Friday, on Wednesday. So that's a soft target, 222.08. But you mentioned something about Apple, which could impact the stock, but we don't have official news of it yet.
Yeah, there's headlines that Warren might be selling more Apple. I saw this in Barron's. It says Berkshire Hathaway likely sold material amount of Apple stock, investors says. So this came from Christopher Bloomstrand on Twitter. He said Berkshire Hathaway will release its second quarter 10Q Saturday morning. I fully expect to see a further material reduction in its Apple investment at 33 times 2024 earnings, essentially no revenue growth over the last 2 years. Yada, yada, yada. Basically just saying that he is certain that Warren is trimming his stake here. So I don't know if we saw any like big lot sales last night after earnings or before, but either way, that could be something to watch for if you are holding a lot of Apple. And again, this we'll know Saturday morning or tomorrow morning.
Not a bad call. Not a bad call. And the reason I say it's not a bad call is 2 reasons. One, he already did. And like when Warren starts buying, Warren buys. When Warren starts selling, Warren sells. Right? I mean, he doesn't like flip-flop like us. Oh, bullish bears. He bakes a steak. Also, you know that he's been unloading, and this is not new information. He's been dumping his Bank of America hand over fist. So it looks like Warren's in the selling mood, and he is already sitting on a pile of cash. So if he's selling on Apple, he's going to get more cash. So very interesting. Warren's in a selling mood. Haven't looked at Oxy. It seems like the last thing I heard him buying was Oxy. We're coming down to the Oxy buy zone area. It's worked a lot of times. So if you want to try it again. But well, I mean, he hasn't flipped the switch on it. Support is support is support. But be interesting. I mean, if you have that in your back of the mind, no matter if you're a shorter term trader, going home long over the weekend, not investment advice on Apple.
All right, well, let's move.
He sold a very small percentage of his stake, 30 points lower, Jay. Very small stake. You could go look that up. All right, go ahead.
Let's go over to Intel, which another, bloodbath here for Intel. So Intel reported adjusted EPS of 2 cents, missed the 10-cent estimate. Sales came in at 12.83 billion, missed the 12.94 billion. Announced it was laying off 15% of its staff. The guidance missed expectations. So just all around, however you want to look at it, was not a good report for Intel. And I mean, we've talked about kind of the environment for the chip stocks right now. And outside of that one day where Nvidia went up 12%, it's been not pretty for the chip stocks. And Intel closed down, over 5% yesterday, and is now trading down another 23%. So this is just, I don't know, Joel. I mean, this chart, you got to tell me what's going on here.
I'm jammed in this thing. I don't even know. Haven't sold in any pops. Very, very small position in one of my portfolios. And it's even smaller today. I just don't know what to say. I mean, from a long-term perspective, I think investors, some big boys just said, this is it. This is it. I'm out. And you get step down sellers, and look at that move that it had, probably way over the expected move. I'll give you the pre-market low. The pre-market low 22.16. You're only at 22.34. I mean, at some point the shorts have to step up here and maybe cover 100 shares or something. But man, you are below your 2015 lows. Oh my gosh, how far do you have to go back on this one? We haven't been 20. All right, $22. Okay. You had a double bottom just under 22 on the monthly chart 11 years ago. 11 years ago. So there you go. That's it. I can't. I'll wait. I don't know. I might even do it today. If I do, I'll let y'all know. Like I said, it's a small position, but I am absolutely sick of talking about it. This company is a total mess. Probably gonna get kicked out of the Dow. Probably gonna get delisted because it's such a crappy company. I mean, what else can you say? And then also, if you want to throw it, make things work, look what these other chips have done at the time. So, time to move on. Intel shoulders. If you've been waiting and you had a bid out there for 11 years to get Intel under $22, this may be your opportunity.
All righty, let's continue on the earnings train here. We did have Snap report last night as well, and I mean, I don't really know what else to say other than another bloodbath for Snap. So EPS came in at 2 cents, in line. Revenue of 1.24 billion, missed by 10 million. The light earnings outlook and weak guidance is hitting the stock. The company talked about increased competition from companies like Meta, which runs Instagram, obviously, and then TikTok. And I mean, if you think about how younger people are consuming social media right now, it's basically all through these short videos, which is dominated by TikTok, but then Meta's coming in on the Instagram Reels and trying to capture some of this market share. And Snapchat is basically being left out. Snapchat does, I mean, like, what's crazy is you look at it, it's still a massively used app. They said the daily active users is now above 400 million people. I mean, that's not nothing. That's like more than 5% of the world right there using Snapchat daily. But the question is how much revenue are they capitalizing on that user base? And it doesn't look like too much. And the stock now is trading back to $10. You go to the chart. I mean, this is an important level here for Snapchat.
Yeah, buy the bottom of the page and sell the top of the page. Well, the top of the page was in July last month, not too long ago. Multiple pokes over 17. That does you absolutely no good right now. We are here. We are at $10. We went sub $10. We went to 973. We got a little bounce up to 1050. Don't know if you're going to get another opportunity here to get this into 10 or 10 flat. But what you're going to need to do is just not make a bottom there in a day. 981 was your low in November. You're going to need to see some kind of agony formation like this, where it makes a low, gets a pop, makes a new low, gets a pop. That's what I'm looking. I'm looking for just kind of junky trading. February, March, April, and May, maybe for 3 or 4 months, just grinding maybe between 950 and 1250. If you're looking for a gap fill on this one, 1271 is the magic number on the upside. But I've never been on it. I don't know if I've ever seen you. You can do funny faces and stuff on there, right? Is that what it's used for?
Yeah.
Okay. I've never been on it. I'm sure no surprise to our listening audience.
All right. Well, let's keep it ticking here. We do want to do more earnings reports. You want to go for some other top headlines from yesterday? We can discuss Meta's price action after the earnings, because you called that, Joel, that it could get AMD'd yesterday after it was trading higher all afternoon into the open and then sold off during the day.
Uh I know someone called me out on that and said no, Meta's not going to get AMD'd, and it might have held up, but it was the market dynamics. Also we talked about this big red bar here. A lot of people got stuck in that one. That range on that day was 508 to 536. Boom, right near all-time high. The world is absolutely falling apart, and you get a chance at the anything over 530 was, well, didn't get to 530. Anything over 520 was absolute gravy, and then you sold off. So Mark, big stock, I don't even know how high it is up in the S&P, but when they're selling the S&P, on most occasions they're going to be selling your Microsoft, your Apple, your Nvidia, your Google, your Amazon, your Berkshire. I don't know. I think Lilly was up to that yesterday and a little bit of flight to safety. Your Broadcom. They're going to be selling your big components, the big components of the S&P. They're big components in tech ETFs. So a lot of times, no matter what the news is on your stock, Mr. Market can kick you in the face.
All right. Well, we did have some more earnings come in this morning from the big energy companies. Let's go ahead and discuss some Chevron, some Exxon Mobil. Chevron, let me go ahead and get those numbers pulled up. Chevron reported a EPS of $2.55, misses by 45 cents, revenue of $51.18 billion, beat by 450 million, declared at $1.63 dividend. Stock trading slightly down here, but I mean, it got crushed yesterday, closed down nearly like 5%, which is a big move for Chevron. So, if you're looking at the energy stocks as a flight to safety here from the big tech market, there could be some potential weakness here, especially as concerns start to mount about a potentially slowing economy and weakening demand in China. Either way, Chevron trading down slightly on this report.
Yeah, bad news yesterday, right? The delay on this deal with Hess. So you read it, Hess got delayed, got whacked yesterday because of the news of, I believe it's one asset they're trying to decide, and it's been thrown out to like even, I think, sometime in 2025. They hit Chevron on that. Also, I think you get a point where, some big institutions or some big investors, maybe they're just not happy with this deal. Maybe they just don't see the synergies. Maybe as, is too, it's just too big as it is, trying to streamline costs. So it's definitely the price, the crude oil price action is not favorable. A lot of different things going on in Chevron. Traded down $1.13 off the pre-market low. Pre-market low 148.01. But you have a number on the monthlies, folks. And if you're a long-term shareholder here, 3 months in a row, you bought them at 152. That's where the big boys stepped up. So you got to do it again. You got to and we're only, 50 cents away from there. But if they're going to shrug off what's going on with this merger, if they're going to, shrug off the recession, if they're going to shrug all this stuff off, and oil's going back to $80 or $85 and holding there, then this will reestablish a 152 bid. I can't really call it major resistance yet because we're only 50 cents away from it. If you're looking at this as a trade or looking, you took it home overnight on the earnings, you don't have that far to go to get out at the mark. The mark was 152.62. Why don't you throw ExxonMobil in with this one?
Yep, let's go to ExxonMobil. Exxon reported EPS of $2.14, beat the $2.01 estimate. Sales came in at $93.06 billion, beat the $90.9 billion. So double beat there for Exxon, declared a 95-cent dividend. Yeah, so the top line numbers were good for Exxon. Total upstream earnings rise 55% year over year, with oil output up 27% in Q2. You are seeing the stock get a little bit of a bounce this morning, but only by about 50 cents. So, probably just not, again, the best day, best week to report here, but numbers look decent for Exxon, stock trading higher by 50 cents.
I just looking at this chart here, just going, can you see this chart, Aaron?
Yep.
What's like a big number to you? Like just long term. And I'm going back. That like what do you think if you had to pick one level where you thought the big boys, and I mean the big boys, big traders, are trying to wiggle out of this stock? Where do you think that level is?
120.
You are move over Edwards and McGee. You are a technical analyst wizard.
I don't even know who that is.
Yeah, it's a book about this thick, man, and I tried to read it. It's so boring. I mean,
Come on, you can just say you've read it. No one will. No
Oh
one will
yeah, I
know.
read Edwards and McGee.
Okay, there you go.
I'll grab
There you
it. I'll
There you
grab it. Yeah, they show charts from the railroads and stuff in there. That's how long ago it was written. Major resistance at 120. I don't know where to buy this thing. You're up. I just longer term. If you're a shareholder here, it just is. Are the big boys going to come down? Like, all right, are they going to give up on getting out at 120? We're only at 117.44 today. First things first, yesterday's high was 119.49. So there's a long-term number for you. We got a creeper rally going here in the S&Ps. We are now 15 handles off that low as we preview the jobs number. You want to try and sneak one more in here, or you want to preview the jobs number?
We got time to sneak one more in. Let's go ahead and go to Coinbase, the biggest crypto market exchange out there. The numbers here for Coinbase, give me a second while they're loading up here in my trusty Benzinga Pro. Go to pro.benzinga.com if you want to check out what I'm looking at here. Coinbase reported EPS of 14 cents, missed by 78 cents. Revenue
Really?
Wow. That's what I'm seeing. And then revenue of 1.45 billion, beat by 90 million there. Subscription and services revenue 530 to 600 million. Let's see if they gave any forward guidance. Not that I'm seeing, but despite that big EPS miss, I think the numbers were seen as pretty good because the stock did get a pop right after the earnings and then kind of gave a little bit of it up, but it's still trading up this morning. $1.86, which isn't a lot, but if you're in the green at all this morning, it looks pretty damn good.
Yeah, hard to find. Four ugly candles, four ugly red candles, due to get a little bounce today. Oh boy, tough one up here. You'll have to find an intermediate number between the where we're at now. I mean, we closed near the lows, so 224 is a gap fill. This can move $10 and get up there and fill that gap. That was also a double bottom. Then it turned into a single top. Man, on the shorter term here, a 200 is sticking out to me as a great support level. But shorter term here, this 210. You had 3 out of 4 lows there. So keep an eye on 210, and where to sell this on a pop is anyone's guess. Let's see if I can get the pre-market low in or pre-market high. Nothing, not much in there, not much of a pop. It's gonna be tough to find a place to sell one. If you do, what do we got? We got 15 seconds. Go ahead. You give the preview, and I am not going to let the algos fake me out on this one. Go ahead.
We're looking for 185,000 jobs. We're looking for a 4.1% unemployment rate. We're looking for hourly wages to grow by 0.3%. Let's see.
Initial move is up. What is the unemployment? Initial move is up. the reaction is down.
Payrolls was 97,000 versus the 148 estimate. U.S. unemployment rate for July was 4.3% versus the 4.1%.
Yikes.
So the unemployment rate ticked higher than what we were expecting. We were expecting for it to stay steady at 4.1%. It did tick higher to 4.3. The non-farm payrolls added less than expected. The non-farm, that was private non-farm payrolls. Total non-farm payrolls, 114,000 versus 176,000. The U6 unemployment rate for July was 7.8% versus the 7.4% prior. So further indications that the labor market is weakening here that will give, the CME watch tool is now showing a decent chance that you will see a 50 basis point cut in September, not a 25 basis point. And so, as long as the inflation numbers don't somehow tick higher than it is looking like, the economy has started slowing down. The Fed might be cutting half of a percent, not just 25 basis points in September. So again, maybe if they could go back again a couple days ago, they would have gone ahead and went with that first initial cut. But either way, we're at where we're at now. We got to wait till September, and market did not like that, huh, Joe?
No, not at all. And I don't know what the head fake
I guess
was.
bad news is bad news is bad news again.
Yeah, there's no, we don't have all well, this is great news because we're going to raise, they're going to lower by a half a point here. It's that unemployment rate. I heard that they didn't want to see anything over like 4.28. I mean, this was the Fed's objective here, right? They wanted to cool the economy. They wanted to slow things down. Well, just like they were a little bit behind inflation, perhaps now they're behind the eight ball. We have cracked 5,400 here for the first time since June. That was a big technical level back in June. You had multiple lows in that area. Right now, this market is not really showing any propensity to bounce off this area. And if you want to look in the 53 handle here, they're playing a hell of a lot here. So not what they wanted. We don't have the rah-rah cheer. Half point is a foregone conclusion yet. Decrease, we will get that. But I see Ryan Dietrich in the background here. I know he's been on the move. Ryan, if you're ready to come on and help us with this messy market, give me a thumbs up. If not, I can see you're feverishly organizing. Now we're in that 53.80 handle. Triple D just took a very expensive fishing trip. Let's go with our guest, Ryan Dietrich. Okay, Statman Do, the man that is traveling across the country informing investors of what's going on in the market. Don't know what you told them yesterday. Ryan Dietrich, Chief Market Strategist at the Carson Group, a longtime guest of the show. Ryan, as you always do, put things in perspective.
Yeah, I'll try to do that today. Boy, you got me on an interesting day. Thanks for having me back, everybody. This is going to be fun. I've been traveling all over the place, but I've got some slides and I'll share them here in a second. I'll just say this. I've come on with you guys all year. We've said we think we're in a bull market. We said we think inflation is last year's problem. Honestly, I'm kind of being a self-promoter accidentally, but my podcast here, Facts versus Feelings, we've been saying for months the Fed can just get on with it, start to cut. And I'll tell you, I'm not bearish, but the concerns are growing. Clearly, when you look at what's happened just this week with some of the economic data, I think the Fed's firmly behind the eight ball, and they probably should have started cutting before. And now here we are. But let's just put some context around things. So I'll go to presentation mode if I can figure it out. Share screen. Give me a second. Which one is it? It's this one. It's this one. Here we go. Yeah, you guys see that? We good?
Yeah, let me go ahead and pop it up here on the screen. We're good.
Perfect.
We got it up.
Yep,
Perfect.
And Ryan, we have a very inquisitive chat. Okay, so what we're going to do is you're going to do this.
Yeah.
And then we'll see if Aaron and I have any questions. And then chat, if you want to pick this guy's brain, there's no one better on Wall Street. So let's do it this way. Okay.
Right. Sounds like it. So yeah, great. I think I put like 10 together real fast here. So I'll just rip through these, give some context. Going to get into everything going on in the news right now, but just big picture, right? We had an incumbent president decide not to run. I found 5 times in history: 1908, 1920, 28, 52, and 68. Those things happen. These are all those years there. Your average year gained 16% when an incumbent decides not to run. Only once were we lower. So just something to think about. Small sample size. I get it, but I kind of like to put things in history. There's a chart. Lots of people have made these. I made one. Lots of bad stuff's happened before. Lots of bad stuff's going to continue to happen. Stocks do continue to do well. Now, honestly, next couple months, I'm probably a little more neutral here. But big picture, we do think we're still in a bull market. I want to be very clear there. But again, those risks with the Fed and what's going on with inflation, which we've been saying a while is last year's problem. Well, it looks like the Fed's behind the 8 ball when you see this data coming in. But I've shared this with you guys every time I've come on. The last 10 times we had a president up for re-election. I get it. Things a little different since last time I saw you. But the market's higher 10 of the last 10 times, up 12% on average. That's on the right there. So it's normal to see some strength in an election year when you have a president up for re-election, which adds to the uncertainty given everything that's just happened. Now, more real time, I thought this was hilarious. I'm sure, Dennis, you'd like this one too. S&P peaked according to Bank of America. Then you've got Bank of America's technician in the bottom left talking about advanced decline lines, the market making a new high. So they're kind of covered either way.
There you go.
Yeah, you gotta like that. But I will say this: I focus more on the bottom left, right? I mean, advanced decline lines, various advanced decline lines, have made new all-time highs just last week. Okay, so we just think it's very rare to have a market just peak. The only time we had a market peak when advanced decline line makes a new all-time high was like right before COVID. Okay, like February of 2020 or somewhere right around then. So there is a lot of rotation. There is a lot of participation. I know things are getting sloppy and messy right now, but big picture, I think I'd still follow with the idea that with various advanced decline lines, breadth leads price. This pullback, we've been on record saying, listen, we've only had 5% pullback all year. After today, it's sure looking like probably number 2. All right. You tend to have, actually, maybe I've got that chart. Where is it? I'll skip ahead. I know I've got it here somewhere. Maybe not. Maybe I don't have it. Well,
I saw a 2% one. Was that?
Yeah. Well, we'll just, it's all right. We'll get the bottom line is you tend to see 3% pullbacks a year. You see 4 or 5% pullbacks a year. You see on average a 10% correction a year. I mean, these are things that are really important to remember. And we're looking at our second 5% pullback, but just also remember here along the lines of that Bank of America thing right here where they said peak for the year. I mean, it's rare to peak in July. Only 3 times in history as markets peaked in July. So was the all-time high last week or the recent all-time high? We'd say probably not. I think that's kind of some things to think about. A good first half to the year. I've come on, other guests have said this, when you're up double digits, the second half of the year, higher 83% of the time, median another 10%. So just some rolling momentum there. But this is a good one because a week ago, let's see, 9 days ago, we had a 2% drop. All right, on the S&P 500. First one in a long time, almost 18 months. Your average year, everyone, sees about 2% drops a year. Now, we'll see what happened yesterday. We thought we might have another one. Who knows what happens today? But just think about this. The last 14 times, a whole year with 5 or less 2% drops, which I still think this year that's probably going to be the case. We get a little indigestion right now, but we only had 1 all year. Last 14 times, market's been higher every single time, up 14% on average. So even your very best years, everyone sees some scary moments, some problems, some headlines that worry you. I wouldn't be shocked at all if we had between us, I've been saying this, but a 6 to 8% pullback sometime before the election. I mean, we're not all that far away from that, with where we are now. So, could we see a 10% correction? Sure. I mean, last year saw a 10% correction, right? From the end of July until the end of October, and then that strong end of year rally. So I still think that, it's not too late. The economy might be slowing a little bit. Are there some cracks? Yeah, there are some cracks, but overall, I still think it comes down to Fed policy. And again, I'd hate to see them do 50 basis point cut in September. It's like, where you been? You could have been cutting the whole time, but maybe that's where we're going to be. So we'll worry about that when we get there. Last time I called you, I think it was 2 months ago, talked about there could be a summer rally, right? It's normal to see a summer rally in election years. Just be aware, August is normally strong in election year. I get it. This is a very, very rough start. The first 2 weeks of August usually aren't that great. Later, August tends to do better. So I wouldn't give up on August just quite yet. Interesting to see with this volatility we've just seen what some of the sentiment polls and different things do. I'm sure there's going to be a good spikes in fear. So maybe we can kind of have that 6 to 8%er, and then that's kind of where things can bottom. And I think that's really what could happen. Rate cuts, couple more. When you're cutting due to a recession, things don't do as well. We're still in the camp. We're not headed into a recession, fully aware things are slowing, but this is more of a normalization cut. You see here, I've got it in front of me here. Normalization cuts higher every time a year later, up 13% on average. And, not only a handful of them, mid 90s and in different times, but still, that's something to be aware of because people hear rate cuts. They think the end of the world because we've had cuts during a 100-year pandemic and the GFC and the tech bubble burst. But you can have periods like 2019. Things are pretty good in 2019. Economy chugging along. There are some rate cuts, and hey, market did fine. Also, I found 20 times the Fed cut with the market within 2% of an all-time high. Who knows where the market's going to be when they cut next time? But yes, the Fed can cut with stocks at all-time highs. 1 year later, stocks higher 20 times. So just remember that one. Small caps, I came all year saying we liked small caps because we thought inflation is going to come back and the Fed's going to cut more than being priced in. I've been at Carson Group for 2 years. We haven't touched long-term treasuries the first ballpark 18 months I was there. I think I was with you guys last time, 2 months ago, saying for the first time we've touched treasuries. We've added some treasuries to the money we run because we expected to see inflation get better. 2 months ago, people were talking about rate hikes. Remember that? How crazy that sounds. We went against that. We faded that, adding a little bit of duration. Again, I mean, we're still bullish, still overweight equities, but we added some duration. We've got 3% gold in some of the models we run. We've got some different alternatives and things in there because, again, this economic cycle is aging. This bull market's aging. I'm not going to be just such a wild bull. I wasn't a wild bull, but such an over-the-top bull like I was this time 18 months ago because I thought things would really look good then. It's kind of getting a little, some of the risks are starting to show up a little bit. But again, we still like this whole rotation thing. I've come all year for a while saying that, and it felt terrible for the longest time. Small caps, yes, they got lit up yesterday. Get it? I don't know what they're doing this morning, but nonetheless, we've seen these blasts of strength up 10% for the month on the Russell 2. You see it there on the top historically. That's rare, very rare. But you tend to see outperformance up 15, 16% a year later. And then we had a 10% jump in only 5 days. We had 4 days in a row, 1% bounce off that CPI a few weeks ago. Those historically are buying thrusts that suggest, again, there's probably more upsides. Still, small caps are really cheap relative to large caps. Our biggest overweight at all year has been mid caps, called the Jane Brady group. No one's talking about mid caps. Everybody's arguing about large and small. Mid caps just closing at an all-time high on a monthly basis just a couple days ago. Okay. I mean, so there is some momentum there in our opinion. A couple more. I shared this last time, but I think it's a neat one. This bull market right now is about 21 months old from October of 2022. Who knows? Maybe it just ended. I don't think it did, though. And that would be one of the shortest bull markets ever, tying the last one we just had, which also went 21 months. You can see the average bull market lasts about 5 years. So just be aware these things can last longer than you think. I think this is interesting. The average up year is 19%. So when the S&P finishes higher on the year, 19% on average. When it finishes lower, what is there? 14% down. So big swings are much more normal with markets. So yes, we were ballpark up 20%. Just feels like not that long ago. Now I know we're giving some back, but the odds again of seeing a bigger move is likely. Also, we haven't seen a 20% back-to-back move since the late 90s, right? We had 20% last year. I still think there's a good chance, if the Fed kind of does what it should be doing, following inflation data, which has been improving drastically, and starts to cut, we still could see a good size fourth quarter rally. I think it makes a lot of sense, and maybe could have back-to-back 20% gains for the first time in a very long time. The consumer's in good shape. I'll just keep it there. I know there are some cracks coming, but again, people really are wealthy. They're wealthier than they've ever been, especially if you look at debt to equity. We hear about all the debt that's out there. I call it denominator blindness. This is just showing how much people are worth in terms of disposable income relative to all the debt that they have. And I know it surprises people, but consumers are in good shape. Not saying everyone's in good shape, not saying if we have a potential policy mistake, because now the economy is slowing and the Fed should have started to cut. I mean, our two big worries, if we talked a week ago, I would have said, hey, maybe a policy mistake, but housing data is not that great and business investment isn't that great. Why? Or small business investment is not that great because interest rates are higher than they need to be. The Fed needed to start cutting. We wish they would have cut Wednesday, but it is what it is. I'll move on. Last one, I believe, the two years since the inverted yield curve. Congratulations to the inverted yield curve. We've heard for 2 years how bad it's going to be. The end is near. Now you could argue, and I get it. In 22, the economy clearly slowed down. We have parts of the economy that went into recession, so maybe the yield curve predicted that. I don't know, but I just know the stock's done really well. And if we go another month, you can see it there. Usually you have 14 months on average after the 210 inverts, and then a recession starts. We still don't have a recession in our view. So that's just something to Actually, you know what? I think this is actually the 110. Sorry, this is the 110 yield curve I'm looking at here. But nonetheless, we've obviously gone long in the tooth since the inversion took place, and we haven't seen a recession yet. I guess this is my last one. If you took $1,000 and invested it only in the Republicans, you'd have $52,000 since Eisenhower. That same thousand. Oh, I'm sorry, that's under Democrats, 62,000. Only under Republicans, 27,000. That same $1,000 invested the whole time, $1.7 million. I like to point that out to people because, listen, the election's coming. Emotions are high. There's going to be some market volatility. Remember June, the worst day all of June for the S&P 500, 41 basis points. 41 basis point drop was the worst day the entire month, and everyone was complaining how boring it was. I don't know. Maybe being boring wasn't so bad when you
Yeah, compared to
when
what
you
we've
deal with
seen.
what we're dealing with now. So I'll stop sharing. I can bring that back up if I need to. But I just realized, I'm sorry, I mentioned Dennis's name. I didn't realize Dennis isn't here. Sorry. So hey, Dennis. Anyway,
He's fishing. He is on a very, very expensive fishing trip.
And I did know that. I don't know. I had only have one screen up, so I didn't quite realize. Anyway, but so there's my quick run through of the markets. Bottom line is probably the most neutral you've seen me in a long time because we are worried that the Fed's way behind the 8 ball here, and they should have cut. And the inflation data, I've been coming on with you guys for 3-4 months, and it's good. Inflation's last year's problem. Let's start worrying about a slowing economy, and now here we are. So there you go. That's my roundup.
So Ryan, when we're looking at these stats, when it comes to like how the market performs after rate cuts and stuff like that, does it matter to you where these cuts are coming from? Because at this point, it's not as if, okay, the economy's humming and inflation's down to 2%, we can cut rates. It's looking more and more like, okay, the Fed is cutting rates because it needs to, and it's willing to, despite the fact that inflation isn't yet quite at 2%.
Yeah, no, exactly. And that's I guess that's the worry, because if they were to cut, 6 weeks ago, when we honestly thought that they could have, and I get it, they want to be very careful. It's an election year, that egg in their face because they were so wrong about transitory, and now we're worried they're wrong on the other side, where inflation, again, if you just look at, everybody talks about this stuff, inflation ex shelter, it's been sub 2% annualized the last 6 months. If you look at real time rents, because we know rents are very, very delayed, our friends at Wisdom Tree share this stuff. If you plug that in, real time rents, CPI is running at 2%, and it has been for a while, because shelter is just such a lagging indicator. So to answer your question, as I get there, yeah, I had on the other chart like panic cuts, cutting during a pandemic. That's a panic cut, right? I worry if things spiral out of control, could we have more of a panic cut in terms of a 50 basis point cut in September? Those odds could be increasing. And what are futures doing? Okay, so Dow's down 500.
We're getting annihilated here.
Another ugly looking day. That's where we are. But again, I guess it's just so important to remember this is only the second 5% correction all year. Okay, mild correction. Assuming we finish there where we are. And again, most years see almost 4 or 5 of those a year. So it's not easy when it's happening. But and for traders out there, probably some people are happy. But what's your guys' take? What are you guys hearing on the whole tech bubble? Tech bubble's the wrong word. You know what I'm trying to say? Tech rotation, and I don't know. Some interesting. We're more neutral tech. We have been all year. We expected some tech weakness, but here it is.
I'll just go first. The AI trade just got super way ahead of itself, and things go to just unreasonable levels, right? And they got to those levels, and now the earnings are coming in, and they're kind of confirming that, like, all this AI. Nvidia's selling chips to create all these things. Well, there has to be a follow through. There has to be some kind of people making money from it. And so far from the earnings reports hasn't indicated it. The thing to me is, like, really in the whole scheme of, a quarter point here, or a half point here, or whatever, a series of cuts. How long does that really take to flow through the economy and change things? And is that going to be the panacea? That's always like, oh, we always rely on that. Is there ever a possibility that things are just going to be what they be, and that you could think the Fed has all this power and everything, but it comes down to it comes down to cycles, it comes down to earnings, it comes down to geopolitics. It's what else has to happen?
No, you're right there. And again, I think that's where, if they would have started cutting to grease the wheels a little bit earlier, we wouldn't have this conversation. We did see earlier this year when yields were lower. I remember when we were hearing 7 cuts to start off the year. We did see big jumps in housing. I mean, housing doesn't make up a lot of GDP, but it's kind of that supersized part. So that could be one positive to the. I mean, what the 10-year broke. I assume the 10-year dropping again this morning. Haven't looked, broke 4%. Obviously, yesterday for the first time in a long time, and 2 years doing the same thing. So we could see a big pop in housing. We could see a pop in small business investment, things like that. But I'm with you. But I think that's where it comes down to. These cycles do last a while, and that's the big question that I mean, everyone's wondering: are we just sliding into a recession, or are we just hitting a little bit of a rough patch? A little bit of a slowdown. We would still side with this as more of a slowdown. Credit markets. Now I know credit spreads are starting to show some warning signs, right? I said my 2 favorite things: advanced decline lines, and what are the credit spreads telling us, right? Advanced decline lines making new all-time highs last week. Credit spreads were okay. Now this week we're finally starting to see some pressure there as junk bonds are really starting to underperform long-term treasuries and things like that. So that's absolutely got my attention. By no means are we seeing major flashing warning signs, but they're starting to creep up a little bit. So if we start to see more worry in the credit markets, then there could be more issues. But I think again, I mean, when I was saying 2 months ago that we released our mid-year outlook, we said, tech neutral. People thought we were crazy. But yesterday, for instance, I believe there were 4 groups that were a positive 1% on the day. Last week, S&P was down, but 437 stocks were higher. And I don't know where we are quite this week. But again, we know what was going on last week. Now, this week, it's maybe a little bit more broad-based selling. But overall, I think it's this is why you don't chase a shiny object. You look for some of the underloved, underappreciated, underowned areas. And there are some. And we think those will be the areas of financial, our biggest weights, financials, industrials, right? I mean, they're still doing pretty good last I checked. A little trouble last 2 days. Everything's been in trouble last 2 days. So we'll see. Yeah.
So Ryan, one last question before we let you go. I know you're a busy man. You've been pretty bullish throughout the last couple of years, even when it was a lonely camp to be bullish there. If there was one thing that you were watching to kind of, know when it was time to, I know you said you're more neutral the next 3 months, but if there was one thing you had to point to be like, okay, there it goes, the bull thesis is out the window, what would it be? I know you shared a chart about, projected earnings growth a while ago or a couple weeks ago that I thought was very interesting because people were making a big deal about the valuations, but you were basically saying look, as long as these earnings growth continue to grow as they're expected to, the valuations aren't that expensive.
Yeah, no, I mean, I was going to say we're looking at still 10% earnings growth year over year this quarter for the first time since late 21. So we are still seeing forward estimates on the S&P 500 increasing. I think we're at 263 right now. It was 224 that started 2 years ago. So we start to see some weakness there. I mean, one of the better, I work with a really smart guy named Sono Varghese. He and I do a lot together. He says he follows macro, and that's what he does. And he says, the initial claims are the one he follows. If we start to see major spikes in initial claims, and just yesterday, we have the highest number in a year. Now, you tend to see spikes in the summer and initial claims, but if we see continued jumps in initial claims, that's that real-time indicator there's some trouble coming. And then, like I talked about, advanced decline lines, I love following those. I mean, again, historically, you make a new all-time high in advanced decline line, the market's higher a year later most of the time. That's not perfect, I get it, but most of the time you're higher, and it leads the market by a good deal. So we start to see more weakness in various advanced decline lines. That'll get me. Also, I love to look at monthly charts. I know it's the start of an ugly month. I mean, the first 2 days here, we got a long way to go in August. So that could work both ways, I'm aware. But if we start to see some nasty candles on monthly charts and things, which we'll know more in a month, those could be some warning signs. I'm not a trader. Used to be in a past life, right? I'm more, we manage billions of dollars, and we're kind of that ship that looks for the longer term trends, and monthly charts can sometimes give some of that away. So we've had a bunch of charts close at monthly 52-week highs or all-time highs just a couple days ago. And I think it's important for at least the more longer-term, intermediate-term investors to remember that when you have some days like today and yesterday.
Got it. Well, Ryan Dietrich from the Carson Group, again, thank you for hopping on Benzinga's pre-market prep with us today. Always a pleasure to get you on. Always a pleasure to get some of those stats that you bring us. We will chat soon and enjoy the rest of your day.
Appreciate it, guys. Thank you.
Of course. Thank you. All right, guys. Always fun to catch up with Ryan. Always good to get us to calm us down a little bit on days like, today and like he said yesterday. And I mean, this whole week has been crazy because you did have that one day where we were up almost as much as we've been down the other days. And that volatility is back. A lot of people were clamoring for it. Now we have it. Now I miss when we didn't have, 3% market moves every day.
For sure. Now we got to bounce, and in the intro, I talked about the propensity of the market to make our high or low for the week on Friday. Well, we've already fulfilled that. Now, as always, on days like this, you're going to get rip roaring rallies and big declines and everything. But right now here we're at 855. You did get at one point 30 handles off that pre-market low. So what you want to do if you're going to do, some
Let's get your
short
charts
term.
back up, Joel.
Oh, I'm sorry.
All good.
We had Brian's up there, Ryan's up there. Now you have to think about, hey, there was some panic selling, wash out here. Do things? Let's see if things start to thicken up ahead. If we go back down towards that pre-market low, 53 set, 53.7650. That was 20 handles than my lowest number on the sheet. If in fact that takes out the rolling front month contract. The low in June was 53.67 and a quarter. But for right now, keep your eye, see where you're washed out on your pre-market lows, and then see what the early action is and how those stocks react at their pre-market lows.
All right. Well, let's see. We've got a couple more. Let's see. I don't know. Do we have any more earnings that we didn't get through yet? Not big ones from yesterday. So we do have a couple minutes here, Joel. So we do some ticker time from the chat.
Yeah, we haven't done ticker time. I know I've been bolting out a little early this week. If someone asks for Nvidia numbers, and I think that's always an interesting stock. And I remember Des talking yesterday, and he's like, "Man, if you're in this for a trade, and we hit $100 in the pre-market, and you're at 120, well, maybe cha-ching, try and ring the register." To me, for a long-term investment, just from a technical point of view, this chart's still kind of messy to me. So what I will do is I will lead on this low from that low, not from yesterday, 102.54. I know in the pre-market it got really close to 100. So that's more of a just for today. Look at that as support. But I think you're going to have a really bad reaction in the market if this thing gets in to double digits. And the reason I say that is just there's nothing in there. This market just has no memory between what's that under 100. I mean, basically, we only spent 4 days, 5 days, about 10 days in the 90 handle. So there you go. I'd be longer term. I'd maybe try and hold out for the lower 90s in Nvidia. Shorter term, you guys can see that 2-day low.
Yeah, I realized we did have at least a couple more earnings from yesterday that we could go through, or we could do more tickers from the chat. We had DraftKings and Roku also report yesterday. 2 Kathy stocks.
Wow. Oh boy, look at that. I gave that multiple, that 42. Well, didn't spend that much time up there, a couple days to sell it.
What is that, a 9-star level?
Yeah. Wow. Look at that at the 50% retracement of that move. Well, what's it? I mean, if you want a bearish projection here, you went from 50 to what? Let's just call it 35. That's a 15-point move. If you want to take it here, I mean, maybe you got a downside objective of 29 here. If you're going to repeat this kind of decline, of course, it's not going to be real easy. But right now, boy, you're at an important level. You're already back to your June low. Probably traded. Let me get the pre-market action in here. But if the bulls are going to come to the rescue, oh, wow, this ain't traded way down here. Traded down to 31.16. So opening up, not really getting a bounce up here. I think you got some more work to do on the downside here. If somehow you get a miraculous pop, 35.36 fills the gap in DraftKings. And what was the other one?
Roku.
Where the heck is Roku? What, $40, $50? 55.88. Trading green on the session. Been in a nice trading range over the last couple of weeks between 55 and 60. Did get it hit a little bit in the pre-market. You can lean on the 55. But until this thing can clear 60 for good, put in the rearview mirror, still looking perhaps this to come down and do some work in the 50 handle. But 55 got a hold here for Roku.
All right, well, that takes us to 9 a.m. Thank you to everyone who tuned in to the show with us today. Thank you to Ryan Dietrich over from the Carson Group. Man, it's been a wild week, but it's been good to do the show every day and catch up with it's good to know what's going on, even when you might not like what's going on. I'll say that. And so, make sure to come in and tune back with us on Monday. Joel, who do we got coming on with us?
You'll have Todd Gordon. Todd Gordon coming on, and I love his perspective on the markets. I know that he is during the recent rally over the last few years, he's been spot on, and wish I would have had him on a week or so ago to see if he turned on this market. But I'm going to be out on Monday, so I will let you guys handle him. Always provides us with good information. Quick note here, folks, keep an eye on your pre-market lows and as well as in the S&Ps, and see if we can find a bid here. Maybe make this ugly week a little less uglier.
All right, guys, smash the like if you haven't already. We will have live trading starting up after this. I'll be making a guest appearance on live trading today, so make sure to tune in for that. We will see you guys next week.